Hi everyone and welcome to Kuvera QuickTakes. Our guest today is Rahul Singh. Rahul is the Chief Investment Officer Equities for Tata Mutual Fund. Rahul heads the fund management and equity research teams for Tata Mutual Fund. He's a mechanical engineer with an MBA in finance from IIM Lucknow, and he's a veteran in financial services with 23 years of experience behind him. Hi Rahul, and thank you for joining us today.
Hi, Neelabh.
So jumping quickly into our question, the question that we have for you today is, what are arbitrage funds?
So arbitrage funds are basically they try and take advantage between the difference between the spot markets and the futures market. So, for example, if there is a stock, for example, Reliance, what we do is we buy 100 shares in the cash market at say 1200 rupees, and we go and short the equal amount in the futures market, same 100 shares at 1210 rupees. So you get that 10 rupees difference. You make that 10 rupees within a month, and I think the difference is pretty much risk free. So you don't make any you're not taking any risk of stock movement in that period. For example, even if Reliance stock price moves up from 1200 to 1300 or 1400, you are assured of this 10 rupees spread. So you do it over a period of time, and you make some kind of a yield on your investments, which typically has been 5 to 6%, and to that extent, you're not taking any risk of equity markets. It's a completely risk-free investment. All you're doing is taking advantage or benefiting from the difference between the spot markets and the cash markets for the same stock for the same number of stocks. So while it's classified as an equity fund, you're not taking any equity risk here. So it's for capital protection. It's for keeping your money safe and still earning a decent yield without paying high tax on it. And so you pay only 15% tax as an equity fund. So I think those are the advantages of an arbitrage.
Right. So what category of investors should think about arbitrage funds?
Arbitrage funds, I think, as I told you, I think it's for investors who are targeting 4 to 6% return and want to pay equity taxation. So anyone who has money in fixed deposits or liquid funds, and they could probably be earning 4% or 5% or 6% also, depending on which bank you're putting the fixed deposit. But you'll have to pay full marginal tax depending on the tax slab of the investor. It's 20%, 30%, 40%. So you're paying on an average 30-35% tax on the interest which you receive. Whereas in an arbitrage fund, you pay only 15% tax. So I think it is beneficial for the investors to move some money out of the liquid funds and fixed deposits into arbitrage funds. Of course, the returns in all the three categories have come down. So today, liquid funds as well as fixed deposits as well as arbitrage funds, the returns are more like 3 to 4%. But that is just because of the higher liquidity in the system. As things normalize, we would think that arbitrage funds, if it's a well-managed arbitrage fund, not a very big arbitrage fund, can generate 1 to 2% more than a liquid fund, or 1 to 2% more than fixed deposits, and pay lower tax. So those, and it's for investors, therefore, who are very risk averse. They don't want to invest into equities. They want to keep 50-60% of their capital in debt. Then this is a very good option. Debt or safe, where they are not taking any risk, then this is a good option.
So in your experience, does volatility in the market, in the broader market, impact returns of arbitrage funds? I mean to say, if markets are moving sideways, then what do you think will be the impact on, what is the relationship between returns and volatility for an arbitrage fund?
So there is no direct correlation. Typically, in a bullish market or in a trending market with some amount of volatility, I think is the ideal time for arbitrage to generate 5-6%. But instead of looking like that, you should also look at the fact that it is also a function of how much returns you're getting in the liquid funds, because money also moves. I mean, if liquid funds are generating only 3%, let's say, which is the case today, then money would move into arbitrage fund, and more money moves into arbitrage funds, the arbitrage returns also come down. So more than looking at the equity market volatility and the direction, I think it's a function of how much money is chasing arbitrage funds. So in the last 3 to 4 months, the trend has been that there's been a lot of inflows into arbitrage fund because people have moved money out of equities. Also, people have moved money out of the debt funds, which were looking much risky in the March-April timeframe. So from both sides, you've got inflows into arbitrage fund, and that has depressed the returns.
Right. So that was great. Thank you so much for your insights, Rahul.
Thank you.